Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Adam Finkel is a proud father, husband, entrepreneur, investor, and co-founder of Tower Capital, a Phoenix-based commercial real estate structured finance firm specializing in debt and equity placement for most commercial real estate asset classes. Since the firm's inception in 2015, it has been involved in close to $2 billion in successful capitalizations on behalf of investors, developers, owners, and operators throughout the country. Adam, welcome to the show.
Thank you. Thank you very much. I appreciate the invitation to be here.
The pleasure's mine. I mean, there's 1,000,001 ways we can take this conversation today. Obviously, you know, the debt and equity portions of anybody in commercial real estate, you know, outside of the deal itself are the two other drivers that make the deal make sense, right? So we always say in this business, you need money and you need a deal. Like outside of those two things, you don't have a business. So I'm looking forward to jumping in on those items. But before we do that, can you just briefly give our listeners where did you start? Where are you now? And how did you get there?
Sure. Well, grew up in Boston originally, transplanted out to Arizona in the early 2000s to go to Arizona State University. Coming out of school, my first job out of college was I was an industrial leasing broker for a boutique firm based in Scottsdale. Cut my teeth dealing with a lot of different types of commercial transactions, large and small. And then I had segued over to Los Angeles during the recession in 2008. I was with a regional tenant rep firm, handling corporate clients, big law firms in San Fernando Valley. I was handling the leasing for some surgery centers in Beverly Hills, Golden Triangle, and facilitating some creative office leases in West LA area. And then I segued back to Phoenix and, really kind of just fell into finance. I was looking for a different opportunity, and I basically found a mentor out here that was working for a company called Johnson Capital at the time, which was one of the largest independent commercial mortgage banking companies in the country. We were the Phoenix office. We had 4 originators. We were one of the more prolific offices in the company. And then they were acquired by a publicly traded firm out of the East Coast. And that was in end of 2014. That's when I really the stars aligned for me to team up with my best friend and start Tower Capital, which, we are a commercial real estate finance firm, based in Phoenix. Our office is actually in Scottsdale. And we are facilitating, financings for all different types of, commercial real estate, hotels, apartments, the new single family build for rent asset class that's really been, gaining a lot of steam throughout the country, retail, industrial, both on acquisitions, refinances, and ground up development. So, we've definitely been keeping pretty busy lately, that's for sure.
Man, I can only imagine. Yeah, especially being spread across a lot of different asset classes. What can you say is, give us a state really of the lending environment in your opinion?
Sure. So, really you have to look at it asset class by asset class. There's some asset classes that lenders, have more favor for than others. Multifamily is a very sought after, asset right now. A lot of markets in the country are seeing a huge undersupply of housing. Hence why vacancies are so low, rents are so high, housing prices are through the roof. So multifamily, the single family build for rent, which is sort of like a sub asset of multifamily, and industrial. Those are the asset classes right now that the capital is really chasing, both on the debt and the equity side. You're seeing, some office, depending on, the market, they're open to some retail. Hospitality, people are still, really shying away from, although, 12, 18 months ago, financing for hospitality was practically non-existent. Now we are financing hotels again. through various different types of capital. So that is coming back, although, still, a lot of hesitation with that.
Yeah, and I wonder, with the hesitation in some of those asset classes, is that the time when buyers should actually be looking, even more heavily at those?
Well, that's what they say, right? Buy low and sell high. So, I think really it's a matter of understanding, real estate is very local. And so you really need to understand, that particular submarket. I think, being able to do deals in your own backyard and knowing that market is really important. I see investors start to get into trouble when, perhaps they've reached some success in a particular market and then they start to branch out. They don't necessarily have boots on the ground there. They don't necessarily understand the nuances of that particular market. And it's much more challenging to be successful. So, it's really important to just understand the economic drivers, what growth is going on. Are there businesses and companies moving there? Is there population moving there? Or is it the opposite? And those are really important things that one needs to consider.
Yeah, I would absolutely assume that's the case. What, on these now being financed hospitality transactions, what are you seeing cap rates looking like? Are they trading at what's the higher rates than maybe they were before, or what's that look like on that front?
Oh gosh, it's pretty broad, kind of depending on what part of the country, the vintage, the flag. Are we talking a Marriott? Are we talking, an IHG product, a choice product? I think probably what you're going to see for cap rates is a range from, maybe like 7% on the low end to, double digits in some places.
Right. That's interesting. That's very interesting. Let's switch gears a little bit. Let's talk about the equity side, if we can. You guys said that you help bring equity to these transactions. What does that mean, and how do you do that?
Sure, great question. So, typically when we're involved on the equity side, it's on, larger transactions, typically, larger development deals. We're utilizing institutional, equity. And so, you have these equity funds, they typically don't really want to write a check less than, $5 million, or some of them $10 million. So, the deals need to be sizable enough. We're really marrying, one sponsor with, one equity group, for a partnership. We're not going out and, chasing down a lot of small investments to, put into a fund or anything like that. It's, deal by deal, bringing a qualified, experienced sponsor to the marketplace, and then, bringing them a qualified equity partner where, the investment goals and objectives between the two are aligned, and just matching that.
How did that work out in the beginning? Let's say you're starting your business, maybe you already had these connections, but just the curious, side of me says, wait, like, how did you end up forming those relationships to say, hey, look, I think I can marry, you as a potential, private equity firm with borrowers? And what did that look like when those conversations took place in the beginning?
Sam, that's a great question. That really is. So when in this now, I'm going to kind of put on my business owner hat, but when I first started the company in 2015, we launched. I was coming out of Johnson Capital. I was just a commercial mortgage banker. I was financing a lot of apartment buildings utilizing, Fannie, Freddie, banks, life companies, credit unions, just a lot of conventional perm debt. My business partner was running a private money debt fund, where, they were basically hard money lenders locally here, providing acquisition capital to sponsors, back in 2012, 13, 14, when, we were in the, the heart of the downturn. A lot of people were, very scared of the Phoenix market for quite some time. And so we kind of had some synergies there where, he was doing the acquisition financing, and then when they stabilized the property, I'd come in and take them out with, the perm. And when we started Tower Capital, we really thought we were going to be more of a private money lender, and we were going to be just utilizing our network of high net worth contacts. And, what happened was I still just had a lot of deals going on with the regular, brokerage and just, financing all this debt. So, we really kind of ended up going in that direction. But what we found was that debt is really a commodity, right? I mean, there's a lot of different places where people can get loans from, even if, within each space, right? There's a million banks, there's a million credit unions. You want Fannie or Freddie, you've got, all of these different seller servicers and DUS lenders you can choose from, and everyone's throwing cheap money at people. And, how do we differentiate ourselves? So what we were thinking was we can differentiate ourselves by being able to bring the equity to the table, because that's, valuable. And by bringing the equity to the table, we would then be able to control the debt. What we really found was at first, we weren't really able to get any traction with the equity placement, because equity placement is very complex. There's a lot of moving parts. And then especially with construction and development, there's a lot of moving parts. And so there's a lot of people in the finance business that don't understand how to structure equity, and they don't understand the development and construction process and all that goes into that. And so, and my partner and I, we have experience with, at the time we had experience with a lot of different types of assets, but we didn't have experience doing equity. We didn't have experience with, ground up construction. So it was challenging for us to get traction in that space, until fast forward, a couple of years later, when we hired, one of my colleagues who was the director of finance for a large Scottsdale-based developer who has developed, award-winning master plan communities and mixed-use projects. And, his acumen when it comes to, equity structuring and the whole construction process is second to none. So, that really allows us to be a true advisor to our clients, not just going out and slapping some terms together, but really going out, understanding the nuances of that, what they should be looking out for, making sure that, the proper language is in there to protect them, making sure the deal is structured properly, helping them with their own internal analysis and spreadsheets and all of that. So, being able to provide that level of service has really helped to grow that side of our business. And that's the most growing side of our business right now for the past few years.
Right. So your business partner comes on, he's got the experience from the development and construction side, but what about marrying that experience with the PE firms themselves?
Sure. So it's really just a matter of understanding what are these different groups' parameters. And so, some of these groups, they're going to want to be out of the deal in 2 to 3 years. Some of these groups, they want to hold for 10 years. Some of these groups are looking for 20 plus IRR. Some of these groups are looking for low teens IRR. Some of these groups want to be in primary markets. Some will go to secondary or more tertiary markets. Some of these people want, will go down to a $5 million check. Some want to write, a 15 and up $1 million check. Some have very specific requirements about the sponsor who they'll work with. How many deals have they done? Have they done deals in this particular market? Have they done deals in this particular asset class? Have they worked with, who's their GC, who's their architect? Have these people worked together before? What is the balance sheet of the sponsorship? And so, it's understanding all of these different parameters and then just really matching the people together. So, we have to know. So really, I mean, that's what keeps me in business is, really understanding all the different capital sources, whether it's debt or equity. The capital markets are changing, more quickly. It seems like more quickly every year. I mean, it's crazy. And just being able to keep up on that. So, I mean, that's why we go to all these different conferences, and, we're part of a larger network of independent, very successful, active commercial mortgage brokers and bankers throughout the country, where we do information sharing and all of these things. And, that's what's made, Tower Capital successful is, having this knowledge and, being able to utilize it for the benefit of our clients.
Yeah, I love that. That's great. One of the things you said was that you guys were, and maybe I butchered the way you said it, but some of the effect of understanding or, using equity so that you can control the debt. What does that mean?
So, oftentimes, the equity partner is going to dictate, what type of debt and what debt parameters that they want. Like they might say, we don't want anything over 60% loan to cost because, maybe they're more conservative. Or they might set forth certain parameters. So you really need to have the equity figured out first before you can go get the debt. If you're trying to do the debt first, it's going to be backwards and it's going to end up being a big waste of time. So when you can bring in the equity partner, then, they're kind of really the controlling partner. You have a relationship with them. And then also you say to the sponsor, okay, well, if I'm going to bring in the equity, I also want to handle the debt because the two hands need to talk to each other. So again, it's much more smoother when you've got one group kind of handling it than, two separate groups trying to do, two separate things.
Right, right. Yeah, that's a great point. That's a great point. What are some of the gotchas, strings attached, things that, let me give a comparison maybe. If you're just a standalone syndicator, you raise all your money from private investors, there's those things that go along with that. How does that change when you start working with larger PE, firm, people writing single checks? What are some things to consider when moving in that direction?
A very good question. It all comes down to control. When a syndicator is going out and you're putting together a bunch of friends and family money or other money, and you're bringing it all together and everyone's writing, smaller checks, you have pretty much total control over what happens. When you're bringing in a private equity group, or some other institutional type, equity life insurance companies, will provide equity on deals as well. And there's other groups that will do this. There's going to be a lot of stipulations that, as far as, budgeting goes, decisions being made on, if they're going to take on more debt for the project, if there's overruns, or when they're going to sell the property for how much. So a developer who's really used to just having full control, it can be an adjustment, dealing with, some of these private equity groups, and they want to see, they're reporting how they want to see it. And, it can be a little bit more cumbersome. Yet at the same time, when you do find a good partner and you do go through the process once, because the first time is always the most challenging, right? But then when you know what to expect, you can really create a well-oiled machine where, you're not reinventing the wheel every time, and it can create a nice smooth transition, especially when an investor, developer, sponsor, whatever you want to call them, if they're in a growth mode, being able to have that one source that's going to commit $250 million to your next 5 projects, it takes a lot of time and energy off their plate than having to try to recapitalize with a bunch of people on every deal. So, there's certainly benefits, but, there are also, some negatives that, need to be considered as well.
Yeah, I would think so. I would think so. And you've alluded to this, early on, but when it comes to experience requirements, I would imagine the bigger the bigger the check that someone is writing, in this case, these equity groups, the bigger the check they write, the more experience they want out of that operator. And yet at the same time, you would think that the more experience an operator has, the less likely that they need that PE firm. Where's the sweet spot on that?
Sure. It's really a situational basis. I mean, like we said, the capital markets are always changing. So you've got new players coming into the market with new programs. You've got, lenders that are here that leave the market, or maybe they're not doing that program anymore or whatnot. So, that certainly can be opportunities that can arise. Maybe if, the sponsor is going to a different market, or maybe jumping into, I don't know, a different asset class or something. But, that kind of leads me to, sort of, what are the equity groups and the capital groups looking for as far as the experience level goes. They want to see people that have, they do have experience in that asset class. They do have experience in that market. It's always a plus if they're, GC, the architect, and whoever else on the team have worked together before, with each other on projects. Now, there's a lot of capital out there that needs to be placed. So, if you can present a good enough story, and, sometimes there's, a capital partner really wants to get into a certain market. Oh, we've been dying to get into Texas. And, now is their chance to get into, well, maybe the sponsor doesn't have as much experience or something, but, there's enough boxes that can be checked to get them comfortable. Another thing that we've seen is, in such a strong market like this, the equity requirements, the cash put in for the particular sponsors, that has come down. The equity partners used to want the sponsors to be putting in, 10, 15, 20% of the equity. Now it's, could be 5%, or it could be something like, okay, well, what's meaningful to you type of thing. So, we have seen some loosening on, some requirements like that, just because, these people do need to get the money out the door, and, it has to be deployed.
Yeah, and that was gonna be one of my questions is, is that a result of our just incredible money printing? All this money's flooding the market and it's got to find a home. And so, yeah, I'm thinking that I'm just theorizing here, but I'm just wondering if that's.
Yeah, no, I agree with you. And, there's been a lot of, fresh powder, quote unquote, for, a few years now. I've been going to these conferences. It wasn't just, after COVID or whatever. I mean, a lot of the trends, obviously, and this is not just in finance or real estate, but in the world in general, a lot of the trends that started to take place prior to COVID have kind of been accelerated, since. And so, it's just an acceleration of what we've seen. And, it's a lot of these groups are having trouble, placing this capital, but, certainly it's, we'll kind of see where this goes. You look in certain markets and you talk about if there's overbuilding and whatnot. And I think, it comes down to supply and demand in a lot of places. But, it'll be, I think that there's been a lack of new products in a lot of different markets, whether it's multifamily or hotels or, whatever. So, I think probably that there is some catching up to do. But I think that certainly everyone is very cognizant of, the additional liquidity that's been placed into the market, and, really kind of keeping their eyes on the, kind of medium term time horizon here.
Right. Yeah, that certainly is fascinating. This may be too big of a topic for the time we have left, but I'll go anyway. You mentioned that, a lot of either lenders or brokers potentially, mortgage don't understand the complexity, or maybe it's even meant this on the sponsor side, the complexity of getting financing for ground up development projects. What does that look like, and what are some of the things that differ on that, say, and how they execute it differently, say, than what a value add multifamily might be?
Sure. Well, really, the big difference on a development project than, if you're just going to buy an existing value add multifamily and you're going to, renovate the units and then, sell it or refinance, with a construction project, you really have to have a good understanding of the timelines and, when are their drawings going to be submitted to whatever municipality? When do they get their permits? When do they get their certificate of occupancy? What's the process? The processes can be different from county to county, state to state. Really understanding, what the zoning will allow. It's, when you're placing capital for these types of deals, what is the exit strategy? Is this going to be a refinance and hold? Are you planning on selling them? If this is a, multifamily project, maybe someone's buying, building condos, are they going to lease those all up for rent? Are they going to sell them? What's the timeline? Do they have pre-sales? With construction also, oftentimes in getting into the, more of the commercial office, industrial, retail, pre-leasing, that's always, very important as well. We are seeing more spec development, especially on the industrial side, happening now. But, there's always a strong focus on, pre-leasing, especially, if the asset class isn't doing as well. So if you're trying to build an office building right now or a big, retail power center, you bet your butt they're going to want to know, if there's pre-leasing, and they're probably going to require something like the property's 50% pre-leased before, they'll really start the process.
Yeah, that's intriguing. That's intriguing. Yeah, I guess as you dig into each of those deals and each of the asset classes, I'm sure all that stuff changes per opportunity. But it is fascinating how those things change and what the requirements on that is. Is there anything else, Adam, before we jump here into the Final Four that you'd like to share with the listeners before we jump in?
I don't really think so. Not in particular.
Okay, cool. Well, this has been super informative. I've really enjoyed this because we've learned a lot really about your business. I know we've kind of gone into the weeds on a few questions, but I think it's exposed some nuance, both to the equity side of things as well as the debt side of things, maybe that some of our listeners may not have understood completely. And I've certainly learned a few things myself. So certainly appreciate you taking the time to walk us through that today. Final four questions are this: if I were to give you $20,000 and $20,000 only to invest in real estate with no previous real estate investing experience, what would you do with it and why?
I would probably, for me, I'd probably throw it into some kind of real estate development dealing, with multifamily or whatnot. If I was just a new investor, what I would probably do is take that 20,000 and buy myself my first rental house or rental property and start small and get my feet wet with something small. And that's what I would probably do with it in that situation.
Right. I love that. Question number 2, if you could help our listeners avoid one mistake in real estate, or in this case, I'll give you the latitude to say when dealing with a mortgage broker like yourself, what would that one mistake be and how would they avoid it?
I would say just the one mistake, it sort of goes back to what, my previous answer was, but I would say for someone is just to start small and not try to do, too large of a project if it's something newer to them. Like if it's a newer asset class that maybe they've, been doing office buildings and now they want to, build an apartment building or, whatever it is. If you're going into a new market or whatnot, oftentimes, I think that you've got to just, get your feet wet and learn your lessons on something small and, rather than jump into something that, might be over your head.
Right. Absolutely. That's great. Question number 3, when it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
One thing I'm doing to make the world a better place. Well, I guess this will be a quick shameless plug. So my company, Tower Capital, 3 years ago, we created a charity car rally event that we do here in Phoenix. That it's basically like a cannonball run through, this year we're doing it through Northern Arizona. And we raise money for a 501c3 called Pierce Family Foundation that raises money to benefit families that have children with life-threatening and debilitating illnesses. Wow. So our next rally will be here October 23rd. And, that's something that we've done. This will be our 3rd year. It's a really great event. It's for an amazing cause. And so I guess that would be what I'm doing right now. One of the things.
Man, that's awesome. I love that. I love that. Very good. Adam, if our listeners want to get in touch with you, what is the best way to do that?
Sure. So you can go to our website, www.towercapllc.com. And you can find all of our contact information there. You can see all of the deals that we're working on. We have a full team. I've got 6 capital advisors. We all have different areas of expertise, whether it's an asset class or, ground up construction or whatnot, that we match, our borrowers with. So, it's a very collaborative process over here. We're doing deals all over the country. So definitely encourage everyone to check us out.
Awesome. Adam, thank you for your time today. I do appreciate it.
Thanks, Sam. I appreciate it as well. Have a great one.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.